Okay, and this week's podcast episode is how to evaluate commercial real estate. And I'm thrilled to introduce Jonathan Kingsley, Vice Chairman at Colliers and a veteran of the commercial real estate industry, focusing on Class A agency and tenant representation services for office and industrial clients in South Florida and across the United States. He also provides investment and asset management consulting services to institutional clients. Jonathan, I'm so thrilled to have you on the show, man. Thank you for being here. We connected several months ago and had a great conversation. Certainly, immediately saw your deep expertise in this space. So absolutely thrilled to have you on the show, man. Thank you for being here.
Thanks, Richard. Great to connect with you again, as always, and look forward to having some bantering back and forth and talking about one of my favorite day job subjects.
Awesome, awesome. So let's kick it off, Jonathan. Strategic considerations. Let's go at a high level. So from a vision and strategy alignments standpoint, how should a company's long-term strategic vision influence the decision to buy versus lease commercial real estate?
Sure. So within the commercial real estate world, it's really a balance sheet issue, right? So certain companies may prefer to preserve their cash, right? Use the cash to put back into the business, back into real estate. So that's generally what we see with most companies and why leasing has become so popular and has been so popular. In other situations, ownership may be necessary because a tenant or an occupier is looking for a particular type of real estate that does not lend itself to lease for whatever reason, operationally, the type of build outs, the type of specificity to a space that isn't found in a common multi-tenant office or industrial building, in which case it would lead those companies or those firms to look to own. And then the final consideration is really market dynamics, right? In South Florida, there's not a lot of product, a lot of space to begin with because we're a land constrained market, and there's less so available for purchase than there is for lease. So the variety, the flexibility, the balance sheet issues are generally the drivers when it comes to that vision.
Okay, and then we'll hit at some point. You mentioned the balance sheet as a kickoff. We'll talk a little bit about the kind of lease standard. This is a financial kind of session here. We'll talk a little bit about not deep expertise, of course, but a little bit about it later. But you absolutely hit the right points around the balance sheet. But as regards market dynamics, what are the key market factors, Jonathan, that businesses should consider when deciding to buy or lease commercial property?
So really comes down to location, right? What's the best location for the business? And sometimes that location is driven by the customer base, being close to the customers. More often we're seeing that it's particularly post-pandemic, what's the location that's most proximate to our employees? And a balance of those two is often the best way to solve for that. We find, ironically, and maybe not surprisingly, but that within the commercial real estate world, you might find a company with 600 or 800 employees, and the decision is made on what's the closest proximate location to the CEO, right? Or the CFO, or the COO, or the C-suite. And those are oftentimes difficult problems to solve for because we know inherently what the best real estate is operationally for a particular company and geographically maybe for the customer base, but is driven on relatively selfish purposes. And we see that all the time, the companies big and small. So we tend to not want to get into confrontation with our clients and saying, no, you can't be there, you shouldn't be there. If they want to be there because that works best for them, then that's the direction that we're going to take it. But it's our obligation strategically to try to find solutions that really take into account every aspect of what's going on with that business. Again, back to balance sheet to a certain extent, proximity to the employees, proximity to suppliers, as well as to customers. And you put together sort of that model and we do deep demographic studies oftentimes to solve for that. And then we can parcel that out. And they say, well, we're really more concerned with access to our customers. Well, then we can take out the employee-based locations and sort for different variables that will help determine what the best location and the best driver is going to be.
So I have a question on that one, Jonathan. Post pandemic, at least in South Florida, we're seeing, some movement, as you say, in terms of C-level folks coming here and bringing operations here from other parts of the country and setting up shop because the CEO wants to be here, etc. And this is obviously a hot market, no pun intended. Is that a prevalent kind of activity across the country, do you think? Kind of these executive folks coming here, setting up shop, and there's other strategic considerations to your point. Some of this may be selfish, but are you seeing that prevalent across the nation, or is it, just certain markets like South Florida and maybe others?
We do see it across the country, but South Florida is just so unique again because it's a land constrained market, right? We've got the Everglades on the west, the Atlantic Ocean on the east, and a lot of development that's happened in between. So you can't really pick and choose where you want to be geographically necessarily. You can decide on a general area, but at the end of the day, it really comes down to what's available, what's going to meet the needs of that tenant or that owner, if it's a purchase situation, the best. And back to the same fundamentals of what's best for our business. Where do we need to be strategically in the best location? For companies that are coming in from other markets, they often don't know that day one. So we have to do a lot of background work ahead of time. They're also not used to the type of pace that it takes to get transactions in the commercial real estate world done. So they think they're moving here in April and they're going to open up an office in May. Never going to happen, right? Even if it's a perfect situation, there's generally some tenant improvements that need to be taken care of. There are ramp up periods, obviously, to get employees into play. So we do a lot of short-term sort of trial, scenarios, and that's where co-working spaces have come in to be very helpful, where you can sort of test out a market area with a short-term lease in a flexible workspace environment, like a Regis or what WeWork has been doing for many years. And that's sometimes a good solution just to sort of get the feet wet, figure out exactly what the best strategy is geographically and product type and type of area for a particular company. And then we do the longer term lease after that once they figure out by beta testing in a certain market area in a certain type of office or industrial facility, as the case may be.
You mentioned WeWork and Regis. Obviously WeWork had its share of issues.
Mhm.
What's happened? Is that still in vogue? Because there was at one point, this is probably a decade or so, that most companies coming into, or many companies, not most, many companies coming into South Florida, at least in this market, would want that kind of gradual staggered entrance and would choose a
Mhm.
WeWork
Mhm.
or a Regis. How popular are those alternatives now?
So during the pandemic, it was a problem because nobody was coming to the office anywhere, and those short-term workspace solutions typically work on a monthly basis, if you will, or short-term basis. So it was a very difficult. But what we found is as companies were coming back to the office, and even small companies, individuals that didn't want to work at home with the baby crying or the landscaper outside with the lawnmower, and that was the most natural way to say, I got to get back in an office somewhere. And the co-working solutions became very popular, and they've continued to gain some momentum subsequent to that. So the WeWorks of the world, the Regises, the Industriuses, the VentureXs, these are all co-working brands that are national brands, are all very, very proficient. They've taken up a lot of space. In a lot of ways, they help the recovery during and post-pandemic because they were the first tenants to show up and say, we'll take big blocks of space because we know Richard needs 2 offices. Jonathan's got, a shop with 3 or 4 people, and they tend to grow. And then the Microsoft of the world and the Googles and the Sony Musics also have taken co-working spaces even in large scale. So they'll be what they call an enterprise tenant, where they'll take 10 or 15 or 20,000 square feet, but it carries with it that flexibility, that short-term ability for them to sort of pivot on a dime if they want to increase in size or decrease in size. So we think that model is here to stay. They've certainly been prolific in the recovery from the pandemic and continuing, and they are generally large occupiers taking large blocks of space, 20, 30, 50,000 square feet in many situations. We've even seen a replacement where WeWork shut down one of its facilities on Miami Beach because it just didn't work for their business model through their bankruptcy reorganization. And a competitor, IWG, which is Regis, came in and took that entire space over. I think that's a 50,000 square foot space, which is a very large center. So that momentum is built and will continue to build. And just because it's not good for WeWork doesn't mean that it's not good for one of their competitors and vice versa.
And Jonathan, if we put the kind of investor hat on, um, investors in commercial real estate with particularly large blocks of space, what's the current mindset? Is it that they believe that we can chunk this out because South Florida, as an example, is a market of smaller to mid-sized companies? Is the mindset that we can get several kind of small companies just renting space, or is it that the bet is really that we'll kind of try to pull one of these larger organizations for them to take half of the building or most of the building? What's the current mindset in this environment?
From the investor perspective, it's kind of the same. And especially in today's environment where we're in a challenged economic environment to a certain extent, which has really trickled up or trickled down, whichever you look at it, to the lender situation. So many landlords now are scrambling to do as as many deals as possible, as quickly as possible, for as least amount of money as possible. And least amount of money means the lowest amount of tenant improvements that they have to put forth for a tenant and the lowest commission. So in order to do that, it's a big block of space in the perfect world. It's limited tenant improvements where the tenant may be paying for their improvements or they're taking the space as is. And then the shorter term means lower commissions, which helps owners, investors today in a challenged debt market, not having to go call for capital from their limited partners, or to have to go to a bank and ask for what we call good news money, which is money for tenant improvements commissions, because lenders are just not opening up the coffers. They're saying, look, you developers, you investors have done very well in your real estate ownership over the last cycle. Now we're in a tough cycle, and you got to start taking some money out of your pocket to pay for these expenses. So that's become a trend that's a challenging one. And again, the co-working models tend to work for that because they take the big blocks of space. They're willing to pay for it, and then they in turn are then just churning through tenants that come in monthly or 6-month terms or some type of other short term.
Got it. Awesome. All right, you mentioned the balance sheet and cash considerations. Let's go a little bit deep on the financial implications here, right? So the typical cost benefit analysis. If you can, John, just walk us through the financial analysis process that businesses should conduct to compare the costs and benefits of buying versus leasing. And let's really focus on the leasing side for the most part.
Sure. So with leasing, it's not a balance sheet issue as much as it's a cash flow issue, right? And most companies do want to preserve their cash to be able to put the cash back into their business to grow the business. That's a fundamental, doesn't matter what kind of economy we've been in, pre-pandemic, pandemic, post-pandemic, et cetera. Other companies feel that there's value in, if they're cash rich, in putting money into real estate, particularly in a hot market like South Florida, because even though we do deal in some cycles like we're going through now, at the end of the day, land constrained market, Latin American influence to South Florida, and just the general population growth that's happening with 900 or 1,000 people a day moving into Florida causes a significant demand for space without enough land to really create more supply like we have in other parts of the state and other parts of the country. So the opportunity to parlay that into a strategy works very well for some, and they feel that we've got a cash balance that's beyond it's not doing its work for us within our business. Let's own the real estate. Let's create a limited partnership that will now lease that space back to our company, and it's a win-win. So the principals own the real estate. They get a return from the company that they're leasing to, and the underlying tenant has the flexibility to be in or out of the space as they need to. So it's kind of a win-win for both scenarios, and that's become a more popular theme as well. Again, with the challenge of finding the right real estate that could be purchased, because there's just not that much available for office space or industrial space today that's affordable.
What are the basics, since we're on the point of investing, what are the basics that possible investors should consider when they're evaluating commercial real estate?
So again, the flexibility, right? How much is it going to cost for me to upfit or to downfit the space for my particular use as a business owner? And what impact does that have on my cash? And am I putting too much money into a piece of real estate that if I try to sell it in the future, I'm not going to necessarily get that value out? So that's generally number one. If it's a very long-term thinking company, they're like, look, we're going to be here for 20, 30 years. We don't really care about the capitalization of our costs or the amortization of those costs. That's a very different analysis, but that's not generally the way companies that we see are evaluating. They're looking on a shorter term, maybe a 5 or 10-year period. So if they're going to put themselves in a weakened position by over improving a piece of real estate, having to put too much money into it, they'd rather transfer that cost to a landlord and just be a traditional tenant, let the landlord pay for those improvements. We'll be the tenant, we'll pay our rent, and we'll have the flexibility in 5 or 10 years to make a change if we need to. So it tends to always come back to that flexibility issue, almost no matter how much money you've got. If it's my business, I prefer to lease because I want that flexibility. I don't know whether I'm going to grow or shrink. If things happen that that we haven't seen in the past, or we have seen in the past, like a pandemic that nobody ever saw before. Owning real estate through a pandemic, when all of a sudden all of your employees are working remotely, becomes a big problem when you're carrying that real estate and you're carrying the business. But if you're a tenant, you can walk away from a lease. It's not going to be the prettiest thing, right? It can create legal challenges and other issues, but you have an escape clause, basically, especially if you negotiate a termination option, or if another tenant comes along and says, I can backfill that space. So those are the type of things that really come to bear, and I think are more apparent now with the pandemic still being very much in everybody's minds. Time heals wounds, and I think our memories will be short at some point. But for now, I think that's really the flexibility issue is the one that the companies look at the most.
Well said. Awesome. Jonathan, just for the newbie investors who are thinking of it, terms like net operating income and cash on cash analysis, just a brief explanation of what those mean and, what are the things that would-be kind of investors need to look out for?
Sure. So the net operating income is strictly a measure of how much rent can I collect after I pay all of my expenses as a landlord relative to my investment in the piece of real estate. So just keeping it simple, if I pay $100 a square foot for a building all in, and I'm getting $3 a square foot in rent, is it really worth it for me to own a piece of real estate for 3% when I can go buy a treasury or even a CD today at a higher value? If I'm buying the building for $100 a square foot, but the business can afford a 10 or 15 or 12 or $15 square foot rent, I'm getting a 10, 12 or 15% return. Now it starts to look pretty attractive, particularly because, again, in South Florida, with the dynamic of lack of supply and lack of land, that real estate's going to continue to appreciate over time anyway. So not only am I getting a nice return along the way, but if I sell it in the future, I'm going to get a nice pop. And that's your internal rate of return, or IRR, which can sometimes be in the double digits, 20, 30, 35% returns if you mark the market correctly. So that's really the game and the trick for an unsophisticated business owner in terms of real estate. It's a scary path to go down. But if it's a sophisticated real estate investor and business owner, or they have the right counsel like you, Richard, to provide the financial services, then there's probably a model that could be built that would demonstrate why it makes sense to own, lease back to the company, and have the benefits of both sources of revenue.
Understood. Perfect. Okay. Thank you for that, Jonathan. All right. So switch ourselves to the kind of lessee now, the tenant. I'm looking for a space. I've got a number of options. What are the financial considerations? How do I evaluate this now? What are the type of costs? What are the gotchas? Would you say, Jonathan, I need to look out as a prospective tenant?
So number one is, depending on the size of the business, you're certainly looking for what's the best deal that I can get, right? And that's generally market based. Do I want to have a Class A building on Brickell Avenue in Miami, which is trading for over $100 a square foot on a lease rate? Or would I prefer to be in suburban Broward County, Fort Lauderdale, where maybe I'm paying $30 or $35 a square foot? How much can my business tolerate? What other considerations do I need to be on Brickell Avenue, because that's where my customer base is, and I need the presence and the opulence and the spill out into the dining and shopping and access to public transportation? Or can I be in the suburban, location where I have a much lower cost of my real estate and I'm still able to accomplish things in the same way? So those are generally the variables that tenants look at. And then you also look at density, because parking is a big issue in South Florida, again, in a land constrained market. Anytime you're in a central business district area, you're going to pay for parking, and you're going to have a lower ratio. You might get 1 or 2 or 3 parking spaces for every 1,000 square feet that you lease, compared to the suburbs, where you'll certainly get 4, 5, 6, and even up to 10 parking spaces per 1,000 square feet, because there's much more land, obviously, in the suburbs. And that may be a consideration which causes a tenant to say, I can't be in a central business district environment because I need heavy parking. I don't want to pay for parking. That can be an additional 20 or 30% occupancy cost. So those are drivers generally that dictate whether we want to be in a higher price market area. Even though everyone would love to be at beautiful space on Brickell Avenue, you may be better off serving your business right by being in the suburbs in a lower cost alternative.
How does the tenant think about tenant improvements and negotiating that into the deal?
Great question, because that becomes, especially in today's environment, really a credit aspect, right? Yep. So if I know I want a perfect space, I know exactly how it's going to be built out, and I go to the landlord, and the landlord's first question is going to be, okay, how much rent are you willing to pay? What lease term? And oh, by the way, let me look at your tax returns, your financials, to make sure that you've got the wherewithal to sustain that lease for the duration of the term, whether it's 5 years, 7 years, 10 years. So in today's environment, especially, back to the point where lenders are not just giving out free cash anymore for tenant improvements and commissions, good news money, it becomes the tenant's responsibility now to fund their own improvements. And that becomes a challenge for many tenants, because again, it goes back to the point of, do I want to put cash back into my business, or do I want to pay for my real estate? So we've been much more challenged in this environment, both for tenants that don't necessarily have the capital, but as importantly for landlords that don't have the capital to be able to attract that tenant, we've got to find spaces that are ready to go, right? What we call plug and play. And in this environment, again, a lot of tenants have closed up shop, some have downsized. We have a lot of sublease space on the market now that we haven't seen for quite some time. So those are creative alternatives, because now you've got a tenant who's in a challenged situation, right? Maybe they need all or none of their space, but they've got it fully furnished, and along comes a new tenant who can take it as is. So there's no challenge in terms of the financials involved around tenant improvement dollars. There's a commission payment obviously needs to occur to the brokers that are handling the transaction, but that's a relatively limited cost. And that's another solution, is just to identify spaces that we know will meet the parameters of the tenant, give them the space that they need, but not put them in a strapped cash condition where they need to come out of pocket to pay for their improvements. In an environment, especially where a landlord's saying either your financials aren't strong enough for us to fund your improvements, or my lender won't even your perfect financial situation, my lender won't give the dollars necessary to improve the space.
Got it. Awesome. Okay. Tax implications. So what are the, just at a high level, Jonathan, what are the potential tax implications for businesses in both these scenarios that could impact the overall financial decision?
So there's certainly some depreciation that's probably to the benefit of owners of real estate, and we try not to be experts in areas where we don't know as much as we do, like financial advisors and CPAs do. But certainly we try to help that along and provide the right guidance on a general level. But ownership does have some benefits, obviously, in terms of deductibility and depreciation. As a tenant, you really don't have those same benefits, but you preserve your cash because you're only paying out monthly, as opposed to having a downstroke or equity that's tied up into the real estate. So the bigger issue really is, where can you get municipal incentives, which are a great benefit to many companies, particularly growth companies coming into the market that are new from other parts of the country. The state of Florida has had a terrific enterprise program in place for many years, with tax incentives, abatements, training dollars for employees, in order to attract new tenants and to retain existing tenants who are, sometimes attracted by lower tax rates in other markets. But municipal incentives generated by the state, and then some participation at the local level, are very helpful to companies to get them started and to help them fund their operations to get going initially. There's a payback period, obviously, on that. You have to commit to a long term. There are audits to make sure that you're following the rules that have allowed you to be awarded those incentives. But that's a huge benefit whether you own or you lease. And there are qualified targeted industries, QTIs they're called, where there are super incentives, like for technology companies, manufacturing, businesses generally that are putting a lot of emphasis back into the economy and helping the GDP grow, as opposed to just a service firm that isn't generating a product necessarily, but that's just providing a service. They're less interesting to the municipal incentive folks at the state level. But it's a very impactful way for companies to get a head start, whether they're new to the market or whether they're looking to potentially relocate to another market and be retained here.
Got it. Jonathan, in my experience, as tenants, we've always batted around common area maintenance, CAM. What's your wisdom and possible advice around how tenants should be looking at this and the ability to negotiate it, review it, audited, and so on,
Great question, because that's been another challenge in a rising market. With the components to operating expenses are real estate taxes, property insurance, and then CAM, as you mentioned, common area maintenance, which includes everything else: janitorial services, electricity, property maintenance, things of that nature. So what we've seen recently is obviously real estate taxes increasing as values are going up in real estate. Insurance has been off the charts, in part because of the storms, right? Storm challenges around the state of Florida, which have caused increases, but more so, believe it or not, because of certain fraud aspects that have happened in the state of Florida, with some scams that have happened around insurance policies. So in the last couple of years, we've really been double hit by incrementally increased real estate taxes and double incrementally increased insurance costs. So for a suburban office building today, you're looking at $15, $16, $17 a square foot for real estate taxes, insurance, and the common area maintenance. 2-3 years ago, that 15, 16, 17 was 11, 12, and 13. So it's got two impacts. Number one is the tenant is now paying a lot more to pay their operating expenses in addition to their base rent, the net operating income that's going to the landlord. Excuse me. And for landlords, if their operating expenses are going up, the rent is going to have to come down to market. So now they're having less net operating income because more dollars are going to the operating expenses. There's less of a gap between those two components. And that's become a significant strain on tenants and landlords alike. So converging forces that are a problem for both parties, yet it's really ultimately has to be solved by the landlord to say, I'm going to have to reduce my net operating income in order to allow a tenant to be at a market rent, or I'm going to lose that tenant to another building. And building to building, it's an unavoidable challenge. As much as there are tax appeals out there for real estate taxes and other ways to try to trim operating expenses, you don't want to reduce the level of service to your building as a landlord and then compromise the integrity of a tenant's occupancy. On the one hand, on the other hand, tenants want to be in a safe, secure environment, but pay as low operating expenses as possible, and that's where the challenge has become a big problem in our industry currently.
I love that. I love that. Okay. So, Jonathan, another pain area for me, at least in my experience, is, the increases, the step up increases in rent over the foreseeable future. What would be your counsel on how tenants should be looking at that and the ability to negotiate that?
It's unfortunate to face the reality. And again, with operating expenses, we do have certain tools that we use with applying caps on the annual increases in operating expenses for controllable operating expenses. So those are expenses other than real estate taxes, insurance, and utilities, which can't be capped because there's no way to cap that. But you can cap, you can force a landlord to negotiate a better landscape contract, a better janitorial contract, to reduce property management fees, things that are controllable that we try to put caps on to help with that aspect. In terms of the base rent increases, again, in an inflationary period, all of a sudden we went from 2.5% and 3% as a market standard for increases, whether an industrial lease or an office lease, and now those increases have gone to 4% and 5%. And that becomes, again, a challenge more for the tenant, but it's a way for the landlord to capture additional revenue to offset those increasing expenses. So it's just a nuance of how we negotiate with, when we're representing a tenant, how we negotiate with a landlord to try to reduce those expenses. And it may be, those increases. It may be offering a landlord a longer lease term, 5 years instead of 3, 7 instead of 5, 10 instead of 7. So they're getting a longer horizon of rent stream, as opposed to a shorter term where they feel like they need to capture those increases on a 2 or 3 year lease in order to make up for the increased expenses. So it's a balancing act between operating expenses and rent. They're not mutually exclusive. They tend to tie together at some point. And again, having a good advocate real estate broker on the side, whether you're the landlord or the tenant, help to develop strategies that work for the particular client's benefit.
Awesome. Thank you. No, that's great. That's great. You mentioned, earlier about the balance sheet. There's clearly a recent lease standard. We won't go into all the gory details of that, but the highest level, 100 feet, let's say, Jonathan, what has been the implications you've seen in the market as regards that lease standard on both lessees and lessors?
Tough really to evaluate because that generally is viewed from the tenant side. Once we complete a transaction for a client, again, whether it's on the landlord or the tenant side, we sort of leave the party, if you will, in terms of how that impacts their investment. We stay in touch with our tenant clients to make sure that the services they're getting are proper, that they don't have a need or they do have a need for growth or for contraction. Same thing when we represent landlords. We help them through stacking their buildings in a way so they don't have a significant amount of rollover expiration the same years, right? You don't want all of your leases rolling over in a 1 or 2 year period. You like to see that stretched over time so you're not burdened with potential vacancy or the cost. So those are the things that we really tend to focus on more than internally on the balance sheet and how it impacts a tenant or landlord, other than negotiating the best economics we can on the front end that carry through that lease term.
Understood. I think for the audience, our advice would be, clearly seek accounting help and guidance on that one. It is a complicated standard. It does have implications for what shows up on your balance sheet now versus what didn't, of course, right of use assets. And that may have implications for EBITDA and profitability measurements, which may have implications for your debt covenants as well. So we won't go into all of that detail in this 1 hour. So except to say that's something you want to be mindful of and clearly seek the expert counsel on that as well.
100%. We know what we know. We don't know what we don't know. Just like a CFO or a CPA shouldn't be managing the brokerage transaction, the
Yeah,
broker shouldn't be handling the financial transaction either, other than bringing the right guidance from other experts to the table.
fair enough, fair enough. Let's get on to the flexibility around operational considerations,
Mhm.
Jonathan. So how can a business assess its need for flexibility in terms of space usage? And how does this affect the decision to lease?
Great question. So we always start with what are the space needs, right? And a tenant may say, I need 10,000 square feet. Well, why do you need 10,000 square feet? Is it based on head count? Are there some other considerations of, spatially of, is it open space because you want everybody out in an open environment? Is it individual offices? So we first do an assessment on head count, and the head count is really based on, are they in a workstation environment or are they in an office space environment? Is this a business that has a lot of training, so you need some big training rooms, or is it just an occasional small conference room? Are you in a remote location geographically where you want to have a large cafe kitchen so that everybody can bring in and eat in? Or are there spill out amenities where you can have a very small cafe because everybody's going outside for lunch every day? So we'll bring in an architect to help do some space planning on the front end. And we'll just take a rectangle or a square, irrespective of where the real estate is and what the real estate is, and say, okay, you've got 100 employees, X amount on workstations, X amount need private offices. We think for that we need a certain amount of conference rooms. Maybe there's one large boardroom and several huddle rooms. Nowadays, companies are still building Zoom rooms, if you will, which are effectively small huddle rooms, but they're built with the sound, capability that is appropriate for Zoom conversations, insulation, things of that nature, the right technology for audio and video. So we'll look at all those factors with a space planning architect and say, on this rectangle, we think you actually need 8,800 square feet, not 10,000. So here we've now found a way to fit what they need for something less on the square footage. You start to negotiate based on that footprint, and maybe you have a little bit of room for future expansion. And also some companies say, well, we're working on a particular project and we know we're going to ramp up to X amount of employees for this period of time, but in 3 years we'll be past that, we'll go back to a more lean approach. So we'll solve for that as well, and we'll build in some flexibility in a lease document to say we're leasing 10,000 square feet for the next 3 years. We're going to sign a 10-year lease, but for the final 7 years, we're going to reduce from 10,000 to 7,500 or whatever the case may be. And it may not be fixed. It may just be that there's certain break points along the lease, at which point the tenant has a period to contract or expand if space is available. We also negotiate rights of first refusal for adjacent spaces, rights of first offer, so that if a landlord knows that a space has become or is becoming available, they offer it to the tenant as an option to either take that space or to refuse it. And that becomes another effective way of dealing with an up and down flow in the type of square footage that a tenant may need.
And going the more extreme case, Jonathan, in terms of scalability, if the plan is to kind of grow aggressively and do the kind of hockey stick, what are the kind of considerations at the outset when we're getting into these?
You never really want a tenant to take more space than they need in that particular time. So you try to create a schedule for what the future looks like, and then build in flexibility aspects within the lease document, expansion rights, rights of first offer, rights of first refusal, as I mentioned, that account for the ability to upsize or downsize over time. Again, depending on the condition of a building, whether it's very well leased or not leased, if it's a 1,000 or 2,000 square foot tenant, they're not going to have the same flexibility as a 20 or 30,000 square foot tenant has to drive some of those flexibility factors. But those are the things that we look for no matter what the situation. And if we don't find a landlord that's going to meet those needs, then we'll move on and we'll find another building where we've got a landlord that can. When we represent the landlord, likewise, we try to counsel our landlords on, let's not make it difficult for this tenant, right? If we want the tenant, we like the credit, we want them to fill the space, let's create some flexibility so that we at least have a chance of keeping them in the building. Rather have 3,000 square feet than no square footage. And sometimes if you chase away a tenant from a landlord perspective, you're shooting yourself in the foot, obviously, for the future, because a bird in the hand is a lot less expensive. A tenant in the building is a lot less expensive than having to wait for the downtime and for whatever else may happen in terms of required improvements from chasing a new tenant to come backfill.
I really like your counsel on the build on current needs and build in the flexibility, because gone are the days now, Jonathan. I've been involved in business like that many years ago, a few decades ago, where you build it and they will come. You have
Mhm.
excess capacity. You have dreams of filling this space with all these employees. And then, of course, business doesn't, you never hit your forecast, right? Not
Mhm.
one way or another, right? Up or down. So, and sometimes you can run into issues with that fixed obligation, right? So I love that counsel. Another area that I've struggled with because I've been involved in high, headcount, large headcount businesses is
Mhm.
parking space.
Mhm.
All right. I don't know if this is a nationwide issue, but certainly in South Florida, you may have a big building, let's say for a call center or, several hundred kind of employee base. Now you got to think about parking.
Mhm.
What's your advice around parking considerations?
So another good question, because that's sometimes overlooked, and it becomes a critical issue because you may walk into a building that's only 60% leased, and you come in as a tenant, you're like, oh, there's plenty of parking here, never have a problem. Well, now when the building becomes 80 or 90% leased, and it's a 4 per thousand ratio, and you're parking yourself at 6 per thousand, there's conflict, right? And your lease calls for 4 per thousand, even though you've had the benefit of using all those extra spaces because the building was relatively vacant. Things change and that becomes a challenge. So we always underwrite that as well. And again, density is great for companies, right? The more people we can put into our space, the better, as opposed to paying for more space. And you've got to make sure that on the front end, as the broker, you understand that and you counsel the tenant to don't get yourself in a situation where you're going to have conflict with your landlord and you're going to be forced to either bus people in or shuttle them in from some offsite parking. Plan for your head count for your parking to match up throughout your lease term. And if not, then let's find that solution on the front end, a retail center down the block that doesn't use all of its parking that you can pay for and you can shuttle people in. Not ideal, but in a land constrained market, we do find that all of the time. And then, as I mentioned earlier, identifying a market area. If you know you're going to be a 4 or 5 or 6 per thousand ratio parker, you're not going to go downtown. It's just never going to work. A, cost, and B, or perhaps A is actually the reality of the number of spaces, and B is the cost associated with that. So guiding landlords and tenants, depending on which side of the table we're working on at that particular time, is really important to not overlook parking. The three things we find that irritate tenants the most when they don't go right are elevators, parking, and air condition, right? So if one of those things goes wrong, it's a problem. Two goes wrong, it's a big problem. Three goes wrong, and it's a what show. So we always try to counsel landlords on tenants on paying attention to those items, and particularly parking, which people become super sensitive to. Because if your employees can't show up and have a place to park, it's a problem. And if the neighboring tenant shows up and doesn't have a place to park, it's even bigger problem because you've caused their problems. So now you've got two tenants with two problems. Never a good situation for the tenant, never a good situation for the landlord.
Awesome. Jonathan, as we've evaluated space, and again, it's my prior experience, particularly with, large headcount organizations. Let's pick an area like call centers.
Mhm.
And let's come full circle to your earlier point about, maybe certain executives having certain areas, to fulfill their kind of personal needs vis-a-vis, the greater population and demographic, right? Because that may be a different consideration altogether, driving distance and so forth. What's your, when, again, from an operations standpoint, trying to pick the right space, what has been some of your kind of challenges and how have you overcome those with kind of high density employees, certain kind of, let's say, hourly pay employees, where it's a bit more difficult to cross county lines and so forth, because that will kind of just eliminate a segment of the population, of course, just by mere distance. How do you get around that? How is your thinking strategically when you think about getting the space in the right location?
So big issue in South Florida, again, with land
Yep.
constraint, A, and B, with lack of a quality public transportation plan,
Yep.
individually by Miami-Dade, Broward, Palm Beach County, and collectively by all of South Florida. There really is no great public transportation, right? They've made efforts with Tri-Rail, which is the train that goes up and down sort of the west side of the greater market area, and then Brightline now that goes up and down the east side. So those are all great, but the problem is getting people to those Tri-Rail and Brightline stations is the challenge because they still have to drive or find some other mode of transportation to get there. And it's not cheap. Tri-Rail is relatively inexpensive, but Brightline, which is the new gold standard for public transportation up and down the East Coast, is very expensive. A colleague of mine had offices here on Brickell Avenue, had a presentation and a tour in Boca Raton last week, and decided he was going to take the Bright Line because it was just a little bit more convenient. So the process was he had to Uber from the office to the Bright Line station, 25 minutes. There was a cost to that, $15. He had to then buy a round trip ticket for the Bright Line, $48. And he had to time it perfectly because it's not like a subway in New York where it's boom, boom, boom every few minutes. It's very set scheduled times. And if you miss that train, you're now stuck for an hour and a half, or maybe overnight if you don't make the last train back. So it's a work in progress, I think, in terms of being a solution. But the challenge is the pace at which you can get from point A to point B, because you may have to go to B and C to get to D, and also the cost, particularly for the average worker. Now, the example I just gave you is a colleague who makes significant amount of six-figure money. He can afford it, right? And we have an expense account to pay for it. But for the typical wage worker, clerical, secretarial, administrative, et cetera, who may be making, $40,000 or $50,000 a year at best, that's a big chunk of money when you figure it's just every day to get the transportation. So until we solve for that in a better way, and I don't know what the solution is, I don't think anybody does, because again, the land constraint of Everglades and ocean and just the infrastructure that's in place, that's probably transportation is the biggest issue facing the growth of this market, and being able to get people to and from their workplaces in an efficient way and in a cost-effective way.
Understand. Got it. Okay. Let's talk about risk management. What are some of the primary risks associated with leasing, and how can businesses mitigate those risks?
So again, I think it comes back to cash flow, right? It's what's the position of the company, what's their ability to afford the rent that they need to pay to be in a location that they want to be in, and that comes back again today to a little bit of the hybrid model, where some companies are saying, like, for everybody to be together, but it's not affordable to pay higher rent. It's not affordable to deal with the transportation issues and costs. So let's have our certain key employees that we know need to be together on a daily basis and have them all in the office and have the rest of the workforce remote. Or let's work this hybrid model where Richard's in the office Monday, Wednesday, Friday, Jonathan's there Tuesday, Thursday. They're working out of the same office, the same individual office or workstation, but it's shared. And now, instead of having one full-time workplace for Richard and one for Jonathan, it's a shared situation, shared environment. So I think risk management does tie into that in a big way, because that's a risk to the business, right? Am I spending too much money on my rent and related occupancy costs in order to get the profit that I need? Or am I better off coming up with some type of other solution where I can have the best of both worlds? So to me, that's really the key ingredient in leasing space is how you manage the risk of the expense versus the ability to generate the revenue necessary off of that risk.
And in a whipsaw market volatility and business cycles going up and down, potentially, Jonathan, just economics one-on-one for the would-be entrepreneur or executive who is considering lease space, what are the kind of economic indicators they should be looking at? I mean, reading possibly the Wall Street Journal or some financial newspaper, etc. What are the things they should be keeping in mind as they're getting into a lease building that is the broader economy that could impact their financial decision?
It's a really tough question. I think, again, not to continue to throw it back to the business itself, but oftentimes you have to look at the sustainability of the business. And I'm not talking about environmental sustainability, I'm talking about the product, right? Whether it's a service or it's a particular product that you're marketing or selling, and what's the trajectory, what's the long-term plan for that? And I think a lot of companies don't think beyond 5 or 10 years. They're thinking 0 to 5 because that's how we're going to get this thing started, and we'll worry about the rest later. Well, the rest later tends to happen pretty quickly. And that's, again, building in a flexibility model to be able to take more space or less space, to upsize or downsize, how your employees are focused on working in a particular office as opposed to remotely. And 4 or 5 years ago, before the pandemic, we wouldn't have thought that way about how is it ever possible for somebody not to show up to work. Nowadays, you can show up to work and be pretty effective as long as there are policies in place and procedures that help ensure that the remote worker, the hybrid worker, is going to be working just as effectively from afar as they are in their office. So I think those weigh very heavily into that in that subject matter, as you look at it on the long term and with the perspective we now have from the pandemic.
Got it. Okay, let's get to kind of more macro matters, Jonathan. Industry specific considerations, right? So, are there any industry specific trends or considerations that businesses in certain sectors should be aware of when making a lease or a buy decision?
Um, Everyone wants to again know what their peers are doing, right? What are their peers doing? What are their colleagues doing? So you sort of follow that map, and it goes back to the old days of McDonald's was the first one to put up a store on a corner. Burger King didn't have to have any strategy. All they had to say, "Where's McDonald's going? I'm going across the street," right? And it's become the same thing over the years with banks and with other retailers that tend to follow, where their competitors are, and they want to capture that same business. So for a typical office tenant or industrial tenant, oftentimes it's the same thing. If I'm a restaurant supply operator, right, in an industrial environment, where's my competition? Why are they located? Is it better access to employee base? Is it better access to where my customer base is? So you can go industry by industry, and you tend to find those groups clustered. Great example is Brickell Avenue. Historically, has been the street to be on if you're a reinsurance company. For whatever reason, one or two populated here. All of a sudden, there were a dozen reinsurance companies on Brickell Avenue several years back. Now that's started to branch out a little bit, but again, it's the herd mentality and following the theme of your competitors. If it's been successful for this company, my company's similar. That's where I want to be, so they'll be successful. So we get that question even now all the time from companies coming in from other parts of the country. Where is ABC company? Why? Because we want to be near our competitor, or in other situations, I want to be as far away from ABC company as possible. Because if we're in the same building, ABC company is doing the same thing that I'm doing in my XYZ company. I don't want that ABC company poaching my employees. I don't want them understanding trade secrets. There's a level of paranoia if you're a creative company or a technology company that goes even deeper than that. So those are the type of variables that come into play in evaluating the real estate from that standpoint as well.
Got it. And how do businesses in specific industries, John, think about Class A versus Class B or other class type of office space? How do they think about that? I mean, are there any particular industries, let's say, that really should be, because of competitive reasons they've just mentioned, should be only thinking about Class A? Are there others, Class B, and maybe other classes, and so on? How does a business think about that?
It generally comes down to price first, right? So
Yep.
I know I've got a budget for my business. Again, whether I'm 1,000-foot tenant or 100,000-foot tenant, I've got a certain amount of money that I like to spend on rent. Where can I be in the best space, the most efficient space, the safest environment, the best parking, the best quality landlord? As you go from A to B to C, you're going to lose some of those variables in the wrong direction. But generally, it starts with what can I afford, and can I be in an A building? Well, you can afford to be in an A building in the suburbs, maybe, but you can't afford to be in an A building in the downtown market, right? Because those rents are always higher. So that's probably the most pressing criteria that comes to bear is I really want to be in an A building, but I just can't afford that rent. But I don't want to be in a building where I'm going to have a hard time retaining and attracting employees, particularly post-pandemic, as many companies are trying to get people back into the office. So the higher quality buildings are the ones that have done the best over the recent recovery period, where the A buildings do well when they've got beautiful space, easy amenities, walkability, maybe public transportation if it's available, the things that would entice the employee base to come back to the office to both attract and retain those employees, as opposed to an employee that says, I like that building down the block better, and I'm going to make a little bit less money, but I like the fact that it's closer to home and it's got the amenities, and I don't have to stress over being in an unsafe environment. So those are the criteria generally that we find that solve for those type of solutions, and then it's an easy decision once the tenant understands the variables and the differences between the two or three classes.
Got it. Wonderful. Okay. The regulatory environment, sticking with the macro theme here, how does the regulatory environment impact the decision to lease or buy commercial real estate?
So that really comes into play more for industrial users, where there may be certain zonings or other obstacles to being able to operate a business in a particular location So we find that more. So heavy industrial, obviously, the not in my backyard type of concept, right? But with office space, not so much regulatory issues at all. It's more functionality within a building. Are there too many rules within the building in terms of ease of access? Do my guests have to check in with a security guard before they get to the elevator? Do they need to be swiped into the elevator? Or can they just get out of their car walk into the building and get up to the particular office space? So the regulatory aspect for office is really more about how a building owner, a landlord, is operating the building and the ease of access and ability to function. But the other aspects really are more industrial oriented in terms of what you're doing in your building, and does it have a zoning or some other type of impact that is not going to be allowed. And there's ways around that, obviously, and that's where we help navigate with variances or with some other type of concession to the community to allow for a heavy industrial user to come into a particular area. But I would say it's pretty low on the list of variables that that we look at for our clients, unless it's a specific industry that we think is going to have a problem being in a particular location. The other piece to that is depending on the quality of the clientele. You mentioned call center users, previously, and it's not to knock call centers because they're a huge part of the success of the American economy. But generally, call center operators are not the highest caliber employees, right? They'll loiter, they'll smoke in public places, things of that nature. So being able to operate your business within the confines of what the rules are for a building, where you're not creating a nuisance or an annoyance to a landlord and to other tenants, is a bigger factor. That it's our job really to help tenants understand you're not going to be happy in this building because you're not going to be happy with the landlord that's going to continue to enforce the rules that are going to be uncomfortable for your employees. So we try to catch that before it becomes a problem. As exciting as it is to do a large deal and bring a tenant into a building with a lot of density, if it's not going to be a comfortable situation for tenant or landlord, it's not going to be a happy situation, and we probably lose that client in the long term. So we're motivated, obviously, to help both sides to navigate through that, and more importantly, to point out to tenants that this probably isn't the best environment because you're going to run into issues, whether it's zoning, regulations, rules in the building, or things of that nature.
Understood. Okay. Some lessons learned. What are the common pitfalls or mistakes that businesses make when deciding whether to buy or lease, and how can businesses avoid them?
Really tough question. Industry by industry, I think it's you got to look at what is your business. How would you, as a tenant, how would you as an owner look at being in a particular building, and would you be a good fit? And how would the landlord look at this situation? If I was the landlord, how would I look at my company as a good citizen or a good tenant? And those are really tough to see because everyone's so excited about the process of identifying and negotiating, for a lease, and then the build out process. It's going to be beautiful, but have you really thought through all the steps along the way over the coming years while you're an occupant, not just in the courting stage, right? The honeymoon is over once you move in and you're established, but what happens after that, and what kind of measures can you take to make sure that it's a happy environment for your employees, that it's a safe environment, that it's a good relationship with the landlord? And we try, just from our experience, we try to point that out to our clients. Again, whether we're on the landlord side, say you ought to look out for this tenant and create certain measures in the lease that prevent potential challenges. And for a tenant, we try to guide them and say, don't try to do something that's outside of the boundaries of your lease document, because it's going to end up being a problem down the road. And then, your focus is away from your business and away from your balance sheet, and it's on operational issues that you never thought that you'd have to solve for. So we just try to anticipate, think ahead a few times, just from prior experience, on what issues can be avoided on the front end just by better education to the tenant or better education to the landlord.
Absolutely. Okay. And thinking ahead, future outlook, let's talk about some future trends. What are emerging trends, Jonathan, in commercial real estate should businesses keep an eye on when making their decision?
So, current trends would be really, am I going to be in a building in this current economic and lender debt environment where I have to underwrite the credit of my landlord, much like in prior cycles, it's the landlord underwriting the credit of the tenant. That's really a big factor. Is the landlord rather, in trouble with the lender? Do they have a loan coming due? Are they paying interest only now? And we know that's going to convert in 2 or 3 years to a much higher interest rate at a fixed interest rate, causing a borrower or a landlord to go into default. So those are new trends that we hadn't seen before, where landlord's credit is evaluated maybe with more scrutiny than a tenant's credit is evaluated, and helping both sides navigate through that to make sure that that our tenant isn't going to be in an environment that's going to be a challenged economic environment by way of a foreclosure. And then likewise for the landlord to make sure that they're not putting themselves in a position with a low credit tenant that's not going to be able to pay the rate, which is going to cause them to go into a tailspin financially as well. So that's one economic trend. The other trend for sure is this whole notion of retention and attraction of employees. Where can we be with the nicest space, with the most collaborative environment? Are we bringing services into the space like massages, mindfulness rooms? Are we bringing in lunches daily or weekly for our employees to make them happy? And what are the things that we can do to make sure that these employees are here to stay? And that's a growing trend where, back to a point earlier about the B and C properties are not doing as well as the A, because the A tend to be in fully amenitized areas. Maybe there's a hotel next door, there's a fitness center within the building, there are lounge areas and play areas, if you will, maybe daycare centers for kids, so that at home folks that were enjoying working at home and taking care of their kids and saving on daycare, now daycare is provided on site by the company or by the building. So those are emerging trends that we didn't see pre-pandemic that now make a lot of sense with or without pandemic, because the world has changed. The attitude toward how space is being utilized, who's coming to work and who's not coming to work, have taken a huge shift. That's, again, it transcends well beyond pandemic and it's just common sense. And that's an emerging trend as we're counseling some of our landlord clients who are developing new buildings on exactly what services and amenities to provide.
Got it. And what are you seeing in post-pandemic in terms of the shift from remote to hybrid to full-time in the office? What are you seeing now?
So there's a lot of mandates out there, but there's a mandate and then there's a mandate that gets enforced. And a very prominent publicly traded Miami-based headquarters company CEO, on whom I'm on the board of trustees for a philanthropic organization, hosted us at his brand new office in Miami about 2 years ago. And at that board meeting, it was at 7 o'clock at night. Somebody said, "Hey, Richard, we'd like to take a look around your beautiful new office space. Can we do that?" And this particular CEO said, "Be happy to do that. You'll find at 8 o'clock tonight, there's the same amount of people in here that there were at 2 o'clock this afternoon." So the question was, well, what are you doing about this? You have this beautiful new office. He says, well, we are implementing our mandate, and starting next week, so we just moved into this office, we'll be telling our employees that you either come to work 5 days a week unless you have an extenuating circumstance, or you can take your excellent skills and you can move to another company that will accommodate your ability to work remotely or on a hybrid basis. That's very rare. We're seeing more and more of that, but law firms, accounting firms, private wealth investment management firms tend to be now taking space that accommodates the requirements of their employees, again, all those amenities, but also in exchange for that, you're going to show up to work every day, or you're going to have to go find another place to work. So that's a huge shift. We've seen some major corporations around the world with leaders that have taken that stance and that position. But I'd say 50% of the mandates today are very soft mandates where we'll work with you. You can come in 2 or 3 days, whatever works. You come in Tuesday, Wednesday, Thursday, and you're off on Friday, Monday, or you're working from home on Friday, Monday. And the other 50% of the companies are saying, you will come to work 5 days a week. If it doesn't work for you, let us know, and we'll be happy to escort you out. So we enjoy that from the real estate perspective. That's certainly a much healthier model for the economy, as well as for particularly for the real estate economy. But that's an evolving process as well, because there's just too many mandates out there that are not being enforced.
Understood. And with the advent of, fulfillment centers popping up everywhere, what's the trend there? A true kind of office commercial properties getting really converted to fulfillment centers and so on. What's your view there, Jonathan?
Not so much. Again, we've seen some of that talk about office space being converted to residential. That's happening in a lot of the other major markets where people have not come back to work in the level that they have in South Florida and in Florida in general. So we don't see those conversions. And again, in a land constrained market with tremendous amount of population growth and Latin American influence, there's just too much natural business and flow going here to keep the equilibrium at all levels, whether it's a rental apartment or it's a rental office or a rental industrial facility, that equilibrium we think is going to continue to build just because of the population growth that we've got here. So fortunately, South Florida is a little bit of an anomaly and immune to some of the challenges we've seen in other parts of the country. So the adaptive reuse or conversion of outdated facilities to something else really isn't happening, except when you get to some of the urban core markets in downtown Fort Lauderdale and downtown Miami in particular, where you're seeing older, small residential buildings that are being scraped and sites aggregated so you can build something bigger and better, right? So take 5 duplexes on 5 different properties, buy them out, and now have one property where you can scale it to a 30-story, condo building or multifamily building. That's the wave of development that's really carrying forward now in a unique way that we're not seeing as much in other markets.
I'm curious what other hotspots in the country. I mean, clearly South Florida has become one of them, even post-pandemic. Shift from to more remote work has led to that. But also, I do want to talk about. I attend some of these tri-county workshops about the demographic shift, particularly with the rise in residential real estate and young families moving out of the state and older folks coming in and retiring and with a boatload of cash and so on. But um, how does that demographic shift, if it's all true, when you get young families, in their prime working years, you've got the older folks who are coming in, buying property, retiring here. What does that mean for the commercial real estate market and business here in South Florida? And I'm going to ask the same question for other hotspots in the US.
Sure. So for South Florida, I think it's the same elsewhere. As population grows, there's a requirement for more services, right? So it's really a stack of events. So it starts with residential. I'm moving to Florida. I need a place to live. Now you've got people coming here. You need to provide services. So you need supermarkets. You need other retailers. In order to support those supermarkets and retailers, you need industrial facilities to supply and support those. And to further support those businesses, you need the office space for the back office and for the accounting and for all the operations that go on around it. So it's really a trickle up effect from residential to retail to industrial to office, the way that we see it. And it's a very healthy cycle to be in when you've got positive population growth. So that's really the story of South Florida, and particularly why you're seeing so much multifamily being developed, because the folks that are moving here either can't afford to buy a home where they can't find it, or both. And that's at every level. So they're forced to a residential scenario. And where it becomes a bit of a problem is obviously Ken Griffin and Citadel, that's been one of the leading major employees in the financial world, coming to South Florida in a huge way, from Palm Beach all the way down to Miami, still having a presence in New York, still having a presence in Chicago. But they hired a residential firm to identify 1,000 residences for their employees that were to move here from Chicago and New York that were making $3 to $6 million a year. And they couldn't find the real estate. Not only couldn't they find the real estate, they couldn't find the private schools, the synagogues, the churches. So as a result, there's been like a pullback now where many of those employees are like, I'm sorry. And it's not just Citadel, just one example, but many companies like that were like, I can't move from New York to South Florida because I can't afford the real estate there to cut my square footage of my home in half and pay double, right? Or I don't want to be a multifamily tenant. I want to own my real estate, my own home. So their option is either to stay with the company and convince the company to be able to stay where they were in another part of the country, or to find a place to work, because it just doesn't, the math doesn't work in terms of the demand on the real estate and then the supply that's available or that will be coming. So good for the multifamily market, but that doesn't solve for people at the higher net worth levels. And I suspect that that's similar in other parts of the country as well. Obviously, the hot spots, Southern California, even now parts of suburban New York, New Jersey, and Westchester County are doing very well. And you can almost go up and down the coast and have those spotty areas. It's the midsection of the country we're seeing the most amount of incentives to draw companies to those areas, because they've got land, they've got people that have left those markets to come to warmer environments during the pandemic, and now realize not just about the pandemic, but it's a great place to live. So we're the beneficiaries. We're a recipient market, but there's a lot of donor markets that are still suffering, and that we're going to continue to see suffer. Just because so much of an outflow to those warm and more inviting environments than the middle parts of the country.
Got it. Okay, fantastic. I love that. No, thanks for that perspective, Jonathan. That's really helpful for me. Okay, technological advances. We're in the final stretch now. How are advances in technology affecting the commercial real estate market and the decision to buy or lease?
Well, we can certainly spend a whole another session
Yes.
talking about technology and
Yes.
particularly AI, which is maybe the most overused terminology that we've got.
Yeah.
But it's scary on the one hand. On the other hand, you got to embrace it because it's making us all much more efficient and I think smarter at what we do. And it encourages us, even older guys like us, encourages us to step up our game to really get a little bit more with it. So we're seeing a lot of applications now in the real estate industry. I'm not overly concerned that from a job replacement standpoint that AI is going to completely take over. I view it more as an enhancement. The bigger challenge, I think, is the education part behind it because we all throw out these buzzwords of ChatGPT and AI. At the end of the day, do we really know much about what that is? It kind of reminds me of the .com days, right in the late '90s, which we were all talking .com, but we didn't really know what .com was until we actually used it. Right now, it's just part of the vernacular. It's a part of way of life. So for me, it's all about getting educated, getting smart on AI as much as we can so we can share that intel with our clients and we can be more effective, more efficient in the way that we operate. But I don't think it's something we should be afraid of. I think it's something we need to embrace. And we're all victims of AI, but we're also suspects of probably being a little bit scared of it. And that's where we really need to, as a community, I think, particularly in South Florida, in the school systems, is educate our young ones on how to better use AI, not as a weapon, but as a tool and as a positive, because right now there's just too much concern that it's going to wipe out all these jobs. And that's just not practical. I really don't think it's going to happen that way. So we can spend a lot more time on the specifics of how that works within the real estate industry, and it's probably a better one to come back to in 2 years and say, "Remember, we talked about AI? Well, here's how it's really working." But that's my view. It's partially scary, but it's also opportunistic. And if we dismiss it, then we're going to be left behind, no matter how old you are. And that's a key part of what I try to impress on my team, and I try to impress on myself actually to always get smart on that technology.
I share that balance view as well, Jonathan. Thank you. Is there a question I should have asked that I didn't?
You haven't because you're always so thorough, and you certainly gave me the ability to be very prepared for this. But I think you've touched on so many great topics, so many subjects that we could do this over a beer or we can do it this way. But either way, I think it's a very effective way to communicate, and hopefully for folks that will listen in, we'll take some pearls of wisdom from you as well as from me, and certainly always available to dialogue with you or anybody else on these subjects going forward. And it'll be fun to do it again at some point and reflect back on what we talked about today and see where we are 2, 3 years from now, before we're both fully retired.
Awesome, Jonathan. What's your parting advice to
Um,
lessees and lessors in the commercial real estate
I
business?
think it's to be patient, to not be intimidated, to not read every headline without reading the depth behind the headline because it could be intimidating, and to, just like getting the right attorney and the right tax accountant and other experts that surround you, wealth managers. It's important that if you're in the real estate world, whether it's residential or commercial, you have the right advisor, the right advocate to be side by side with you to guide you through specific situations. We've talked a lot about macro concepts today, but really we drill in very heavily on the micro concepts related to servicing our clients, again, whether they're landlord clients or tenant rep clients. And it's just always having the right advisors in every aspect, right? We're therapists, we're professionals, we're sometimes very financially skilled, we're demographically skilled. We bring a lot to the table that can help make the right decisions, and don't be afraid to find the right solution, the right person that really has the right rapport to represent your interests in what we do.
Well, Jonathan, thank you. This has been a tremendous hour or so. Wow, what fantastic wisdom bites. This is not an easy topic, particularly for newbies who are going into the commercial real estate space here, but this has been tremendous, and I really appreciate this. And what you and Colliers do is fantastic. I've known you, your team as well. I've met them. I see how you operate your business on a very independent basis, representing the right clientele. It's been superb. So thank you for your service to the local and national community as well. Thank you for that, Jonathan.
Thank you, Richard. Always a pleasure, and I love to do it again soon.
Take care of yourself now, Jonathan. Thank you
You
again.
too.
All the
Cheers.
best.
Thanks.
Bye-bye.